Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Vincent Deluard, Global Head of Macro Strategy at StoneX. Hi, Vincent.
Hi, Maggie. Good to be with you. How are you doing?
It's good to be with you too. I'm doing well. Thank you, everyone, for your patience. We had a little bit of trouble connecting. My constant thing is technology is trying to kill us. And Vincent's also going to power through with a hoarse voice, a little bit of sickness creeping up. Vincent, is that right?
I believe it's COVID, yes.
Oh. But Vincent, I appreciate the fact that you just get right to it, right? You don't mess around, you don't bullshit about anything. You're just like, this is what's happening, which is what you do for us for macro too. Because normally people are saying, I think I have allergies. I don't know what it is, but you're like, no, I think it's COVID. This is where we are. Well, I appreciate you rolling in a little bit under the weather. Um, and for us, it's the second time to chat in a week, which is really exciting. And so last time we connected, it was like buy everything, Fed aggressive move. And since then, we saw exactly that, right? Stocks have been rallying to record highs. I guess the question everyone's thinking about is what happens from here? What have you made of the whole sort of rally we've seen? And is all the good news priced in? Is the Fed pivot priced in?
I mean, the move made sense to me. I mean, you have the Fed that's, cutting by 50 when you have the stock market at an all-time high. Um, Real growth, GDP growth for 3%, earnings expectation of 15%. Um, in terms of direction, I think probably makes more sense to buy international stocks today than US. Maybe that's what's in store for the coming years is outperformance by international. But when it comes to stocks versus bonds, yeah, it still makes sense. I mean, I'm a believer in the no landing scenario. I think the biggest risk is still that we declare victory too early, that we have inflation. Actually, many indicators inflation is already coming back. If you look at core ex housing, core service ex housing, it's accelerating. Housing is accelerating again. Core PPI is accelerating. So I think the biggest risk going into 2025 is that we have to undo some of these Fed cuts and that we have high inflation. But that's probably a story for later. I mean, for now, yeah, it's the basically people are just following the parallel playbook.
Yeah. I think you just said something really important, which is there are two things we have to hold in our mind, the immediate short term and then the longer term. And it's important to kind of, I guess, get ready for both. But right now we've seen that move. It sounds like you're saying that the market is really kind of trading more on the sort of uh the liquidity coming from the Fed and the flows as opposed to really fundamentals. Is that fair, or do the fundamentals also justify some of these levels that we've seen? Because there are concerns about valuations.
Yeah. Again, valuations are a relative game, right? I mean, it's as opposed to what. And
Mm.
when we had cash at 5.5%, you know, and the 2 year at 5%, I was a lot more worried about these valuations than I am today. Um, if we really do see the Fed cut 9 more times from here, which is what the futures market has priced, yeah, you may not like to buy the S&P 500 22 times earnings, but it sure beats cash at 2% in a year, or the 10 year at 3.5. So I mean, there could be just a return of that. Tina, there is no alternative. Cash is trash mentality. You have 7 trillion in money market funds that you know I mean, made a lot of sense to be in money market funds at 5.5%. If the Fed does cut as aggressively as the market prices, that money is going to come out. Now the question is where it's going to go to. My view is that it's probably more likely to leak into international stocks because the
Mm.
valuation is much better there, but some of that will go into US equities as well.
Yeah, and we haven't really heard a lot about that because there is all this money that's sitting in cash, and then people were sort of licking their chops at the idea that maybe we would see that redirected. I think that's what all the anticipation of the pivot was. When we look across internationally, so I understand when you say valuations are cheaper, but it's got to have the earnings behind it as well, or is it also relative at that point? Because let's look at Europe, for example. this argument, Europe's been cheaper than the US, it's been like that for a while, and it just continues to seem to outperform. Has that changed in your mind?
Yeah, no, Europe is, if you could have the poster child for value trap, value trap is a stock that has great value and will offer even greater value in the future because the price keeps getting hammered. That's pretty much the experience of investing in Europe since 2008, really.
Mm.
And probably Europe is the weaker part of that case for international stocks. I mean, we can talk about it, but I'm quite bearish on the euro. Um, but I think you're right about the valuations not being a timing tool. I mean, you hear all these stories. Oh, like China is cheap, right? China is cheap. It's been cheap for 10 years, getting cheaper. So, in order to make a case for rotation, you need not only the valuation case, but also some sort of macro thesis to accompany it. And to me, that macro thesis really has three characteristics. One is maybe the tech cycle rolling over in the US. I mean, we'll have to see, but it's been more than a year now that the NASDAQ 100 has underperformed the Russell 2000. We are seeing some layoffs in tech, in the AI space particularly. We are seeing some of the hype kind of come down. The advances of the latest LLM is not as good as it was supposed to be. Obviously, the investment cycle by the hyperscaler is not something that's going to be repeated over time. So we could see, and basically the fate of the US is wedded to that of tech. So if we see tech kind of roll over, that could be a reason for this international trade. The second trigger, which I think is very important because that's what started everything, is the Bank of Japan moving away from financial repression, easy policy, the end of the yen carry trade. I think a lot of money that came into specifically US tech stocks came from Japan. I mean, we have SoftBank. We have a lot of very popular trade, right? You borrow in yen, you buy the Nikkei. I mean, if you like the way so you borrow in yen, you buy the Nasdaq. If you like the Nasdaq chart, do it in yen. It's twice as good, right? So some of that money is coming out, and that's a huge source of saving. I mean, Japanese savings are probably $300-400 billion a year. So the US is getting a good chunk of that with leverage player like SoftBank. And then the third trigger is finally what we're talking about, which is um, the Fed moving from, at least relative to developed markets, the Fed was the most hawkish of the developed market central banks up until last week, right? The Fed had that, hike the first, did these mega hikes at the beginning, brought to 5.5, was staying put, we had seen cuts in Canada, Europe, Switzerland, and now we see the Fed actually outdoving its peers. So end of Japanese carry trade, dovish Fed, and then an end of the tech cycle. You could see how that could all act as a trigger for finally realizing some of this value in international stocks, which could receive some of that cash that we see in money market funds.
So if Europe has, and I do want to get your view on the euro, but let's just stay with this for a second because I think it's really important and really interesting. If the European economy looks weak, is there a specific international markets that you think will get more attention? Are we talking about, because that's a really broad term, right? Are we talking about LATAM? Are we talking about emerging markets? Is it Japan and Asia that get a look, sort of ex China? Are we carving Europe out of that?
Well, I mean, Europe, I think you always have to look at it on an almost company by company basis. And you could have this divergence between the exporters who are globally competitive, well-run companies that have nothing to do with. I mean, I do forecast weakness in the European economy. I do also forecast a political crisis in Europe. But if you're a big pharmaceutical company, your performance has to do with some of these companies make 60-70% of the sales in the US. Or a lot of the industrial exporters make a lot more money in Asia than they do Europe. So I could see a world where Europe is underperforming. The euro is weak. The European economy is underperforming, but the stock market is actually quite fine. For the rest of the world, I really think we need to talk about China at this point. I just saw this headline that China's weight in the MSCI World Index is now 2.4%. I mean, that's below India, that's below Switzerland, that's below France. Um, and if you just add the max six, the six tech stocks, you're at 13%. I mean, would you have? I mean, they're great stocks, right? You have six stocks, or the entire future value, the current value of the future profits of the world's largest economy, six times that. I think we are this point You only see at major secular laws when really the and you can compare any company you want to compare at. I mean, tech is always a good one, right? You do Baidu, Google, Amazon, Alibaba. I mean, you see the kind of trajectory that's being priced is literally like China is not going to be around for the next 5 years, or at least we won't be able to invest in it. Um, that's what the market's pricing. So if you think that's excessive, I think that's probably where the opportunity is.
So, but there are people who think that, right? So it's very
Yeah.
interesting when we talk about China because there are people who you see it all day on X that they say China is uninvestable, it is imploding, and that even if it manages to avert that, and it's just like the best case scenario is Japan, that's been the popular one this week, then uh, the way they treat businesses in the private sector it doesn't mean that even if the economy manages to move forward, that as an investor, that it's an investable market and safe. There's a lot of political risk people are concerned about. Do you not see that? Or are you just saying even with that out there, prices are so low that it's sort of worth that risk?
No, I see that, and listen. For the longest time, I had this view that China is for bond, the US is for stocks,
Mm,
and basically based on what you just said, it's like what do what do people care about? Right? In the US, we care about the stock market. And Donald Trump, when he was president, would tweet every time the Dow would have an all-time high, a new high. We have a pension funds that own equities, which ensures that more money gets into equities, and that if equities underperform, that's a problem for society as a whole. So that's the US and equity culture. China, the most important thing that China cares about is the bond market, because they want the yuan to be an international reserve currency, and for that they need the Chinese bond to be the Chinese government bond to be a good store of value. And by and large, that trade, which I've had for years, long US stock, long Chinese bonds. I mean, Chinese government bonds have outperformed everybody because the long bond in China kept falling in terms of yield. So you got a big gain. The yuan has actually been quite strong, confounding all the same crowd that you're talking about telling you China's going to implode. I mean, look at the chart. These guys have been telling you to short the yuan in Hong Kong for
mm,
10 years, and
mm.
that's never worked. I mean, all you've done is like give money to the the Hong Kong Metro Authority. So in general, I think what you say is correct. That um, the US will take care of shareholders, and China will take care of bondholders. There is still, nonetheless, a point at which the level of the equity market becomes a problem, and I think we're getting close to that in China. You cannot pretend to be an economic superpower and have a stock market whose value is less than that of Switzerland, where the index hasn't gone nowhere in 30 years. So we are starting to see some moves there. It's very similar to what we saw in '08, by the way, in the US, whether it's preventing shorting, creating a sort of national team to buy stocks.
Mm,
I think the big scare was what happened to Jack Ma and Alibaba. That was a couple of years ago.
mm.
But I I think it's somehow overcorrected. And again, typically, there's a reason why stocks trade at 6 or 7 times earnings. I mean, it's because you're buying them at a bad time. So you'll never see a perfect environment and stocks trading at 6 times earnings.
Right. That's it's a great point, right? When the arguments are so obvious, then it's already happened. I think it's a good comment though, and a good clarification because you'll have to take into account your risk profile. It's not for the faint of heart right now when you're going in, and looking for a bottom. Let's pivot back to Europe for a second. Great point about the multinationals. I just made it on the flip side with the US with another person I was talking about earlier today. So, you do have to kind of carve out when you're looking at an economy and maybe small to mid caps, which are very exposed to that economy. And then when you're talking about these huge global multinationals that kind of operate in their own, even if they're domiciled somewhere that kind of have their own global economics to consider. What is your outlook for the euro though? And are we going to see rate cuts from the European Central Bank, and will that help the growth prospect in Europe in the coming days? How do you see that playing out? Because I think you are expecting a really weak euro, right?
Yeah. I mean, part of that has changed a little bit with the Fed decision. I mean, I must disclose that I was on the wrong side of the 50 versus 25. I expected the Fed to be more hawkish, and I mean, I think you really need to recalibrate. If what we've seen is a genuine pivot by the Fed, something that's going to be sustained over time, where they tell you, hey, we don't care about inflation. We are labor market Fed. That kind of changes the currency. That means we're getting into a real weak dollar cycle. That was not my expectation, and I'm still somewhat on the fence about it, because I think if you just look at the economic fundamentals, objectively, the U.S. is so much better off than Europe. I mean, only policy can do anything, right? But if you just look at the fundamentals, we have this, 3% real GDP growth for many quarters. We have actually reaccelerating inflation. We're going to have more fiscal stimulus coming through. All that is kind of the higher for longer, higher, uh, strong dollar trade, basically. Um, and you could see the exact opposite in Europe, right? In Europe, we have a very weak economy. I mean, the anecdote I keep pointing to is Volkswagen closing the plants in um, Saxony,
Mm.
where you know Volkswagen never closed a plant in Germany since the end of the war. And that's a big, that's part of the social contract, right? In
Yeah.
Germany, they may not have a great power or seat at the UN or the right to have an army, but at least you have a good economy. And if you work hard, you'll be hired by a great company in your local town, and you'll work your entire career there, and so will your kid. And if demand is weak for whatever reason, they will put you on a partial where they keep most of your pay going, and you'll have a seat on the board. That's the German economic model, and you see that's breaking down under our very eyes. German car production is still one third lower than it was pre-COVID because
Mm.
they're getting displaced by this cheap Chinese export. They're late on the electrification, and they face these high energy costs. And you can do the same thing with machinery, with chemistry. Pretty much the entire industrial economy of Europe is getting hammered, and there's really no good plan to get out of it. So you have that's going on in Germany. Now, France is a bit less exposed to the industrial part because we destroyed our industry faster. So there's not much left to destroy. But we still, Germany is still our largest trade partner, and they're weak, so that drags us down. And then we have a fiscal situation in France that is horrible. I think at the end of the day, that was the reason why we had all this crisis in the summer in France, with the election, basically the president called an early election, and no one really won. He lost for sure, but no one really won. It's because there is $100 billion hole in the French budget
Mm.
that the Minister of Finance knew and just didn't want to be accountable for. So like, okay, I'm out. Let someone deal with this. And we've
Hot
been dealing
potato.
with for 3 months now, with basically every party. As soon as they realize what's happening, they're, oh, I don't want to be the one doing that. And we violation of European rules on that. There's an excessive deficit procedure by the European Commission. And again, France is not a problem you can brush off. Like, the Greeks, we could basically bully them into compliance and tell them to vote again until they vote right. Or we could just, shut down their banks from the euro system. I mean, you cannot do that with France. So I think we're going to have this toxic mix of a deep economic crisis in Europe and a political crisis in France, which will make the euro a very weak currency.
I'm
Um,
so glad you mentioned that, by the way, because as you're explaining the situation and laying it out, I was just thinking to myself, do you remember when we were all in the European crisis and the periphery and what happened with Greece? But you're right, feels a little different now that it's core, right? I mean, different playbook, and you're not hearing nearly the same outcry and policy moves that you
yeah,
did back then. So
I mean, we
extraordinary. I'm
also
sure
we
not
also
lost on the
quite
Greeks or anyone who's sitting in Spain either.
Yeah, we're also quite early in that process. I think the market has not realized how bad the situation is, and I think we have like more of this cycle to go through where we submit a budget, it gets rejected, people protest, economy keeps slowing. So we're still in the early, in the analog would probably be around 2007, not
Wow. So
2011.
would at the time, that was an issue for the global economy. It felt like one.
Yeah,
A lot's happened obviously since then, but will it have that same um disruptive feel to the global economy, or are we so kind of deadened by these sort of never-ending crisis that we won't see the same kind of fallout, or it will be limited to the euro?
There's a chance. I mean, all else equal. I mean, that's not an insane stat. If you look on nominal dollars relative to the US, the Eurozone economy has shrunk by 50% since 2008. 50%. I mean, we were of comparable size in
Hmm.
2007. And now that part of it is exchange rate, right? The euro is 1.6 at the peak. Now it's closer to 1 or 1.1. And part of that is lower nominal growth. For about 15 years now, there's about a 2% point growth gap nominal between France and between the eurozone and the US. So perhaps the eurozone is less systemically important than it was 15 years ago. I mean, it could be that when people talk about Japan, and I maybe they were they always mention China is next Japan, China is next Japan, right? Maybe that's more the eurozone, right, where you have this basically lost decade ahead of us, where all we can kind of agree on doing is keeping rates at zero and trashing the currency because we don't know
Mm.
what to do on how to kind of
Which is
kickstart
terrifying,
the
and
currency.
a cautionary tale for anyone who's just looking at European stocks and think they're cheap unless they fall into that sort of extraordinary multinational, global company as opposed to European company. By the way, Christopher, who we can always rely on in the chat, not only for great trading and investing ideas and information, but also for drinks, says for Vincent, 2 ounces of bourbon, 1/4 ounce lemon juice, 2 ounces of orange juice, 3 tablespoons of honey, mix well, and then shake with 4 ice cubes. You will feel much better. This is not FDA approved. That sounds a bit like a hot toddy, if I'm not mistaken, Christopher.
When the market closes,
I know, and I'm just thinking what a trooper you are, to not have bailed, Vincent, and to join us to share what is some amazing insight here. And I always tell Vincent I love his original thinking, and he's not afraid. I put in the chat earlier to be a contrarian, which is important, and to kind of try to look ahead, which is not very popular. Herd mentality is very much in vogue, but this idea that Europe could be Japan. So related to that, Vincent, you right a couple weeks ago, I saw something and I was like, that is an absolute brilliant statement. I want to talk to you about that. You suggested that carry trades don't die; they just move.
Mhm.
Is it possible that the yen carry trade moves over to Europe and we're looking at a euro? Or are there distinctions there that make it just more expensive and harder to do?
Well, I mean, at this point, it's still more expensive to do in Europe. But if you think you're not going to be able to do it in Japan, Europe is the next place you want to do it at, right? So the policy rate in Japan is still zero or point something, right? But I mean, the Bank of Japan, I mean, in a high class meeting, but they said they're definitely in a hiking cycle, which is again, Japan always seems to be beating to its own drum, right? As the world counts, they're hiking, and more importantly, I think the Bank of Japan and the Minister of Finance in Japan really have come to see this carry trade as harmful to
Hmm.
Japanese corporation. To yeah, they start to see this import inflation that they don't want. The yen is being seen as too weak, so it's not so much about the size of the moves themselves, but about the mindset. Also, with what in Japan was important is the balance sheet policy. Right? I mean, they have this massive balance because the Bank of Japan has been buying JGBs for so long. They own more than 100% of GDP on their balance sheet. So they decided to roll off a little bit less. So that means instead of being net suppliers of capital, capital is being sucked back into Japan. So I think, yes, the Japanese carry trade is probably living its last days over. Now, the point that I was making is carry trade don't die, they just move, right? Well, if carry trade, you're just arbitraging between rates, right? So if you could borrow at 0% in Japan and invest at 12% in Brazil, that was great. Now you can't borrow at 0% in Japan because you're afraid that the yen is going to rip 10% in your face. What's the next thing you do? Well, you borrow at 2% in Europe, and that 2%, by the way, 3% now. That 3% is coming down. I think very rapidly because you have a very strong case for cutting rates in Europe, much better than the US. I mean, inflation is way below 2% already in Europe. The economy is slowing, the unemployment rate is much higher. And then we have this political situation that will basically ensure that you have tremendous pressure on the currency. uh, bad headline risk. So, because again, the carry trade, there's the carry, and then there is what the currency does, right? And I think I can see the scenario where the yen rallies 15%. Um, I can see a scenario where the euro drop by 10%.
Wow, and that would be a big move. We have a couple of, we're having a very robust chat about German ancestry, which I love in the chat. They're always they're always a wild bunch, but we have a question about, from Paul about where you see rates, just different parts of the curve, just wondering how you're thinking about it. And I'm just curious what you think about the reaction Treasuries overall to the Fed. We got that aggressive move. It's been kind of interesting
Right.
to watch what's happening with yield. So sorry, it was Oliver. What maturity bonds look interesting to you? 3 to 5 years? Seems like no one wants longer term issues.
Yeah. In the US, it's kind of hard for me to be excited about any part of the curve. I'm in the view that inflation is gonna average, 3-4% for the next decade. That maybe we won't even have a recession, or at least certainly not in nominal terms. So, um, I guess there are parts that are better than others. But 3.7 on the 10 year seems to be very uh yeah, you're not getting anything for your money. I mean, uh, in general, you should have about 100 to 150 basis point of term premium. Um, so above the neutral rate. So if you see the 10 year at 3.7, I mean, that means that somehow that neutral rate is in at 2%. I mean, that seems way too low to me.
Yeah,
And
this
then
goes back to your
in the
point
front end,
about stocks
I
look
actually think
good
that the front
relative to
end,
bonds,
yeah,
right?
yeah. In the front end, I think the part that's more tradable maybe is maybe not the immediate cuts. Obviously, I was wrong on the 50 versus 25, and maybe I'm gonna be wrong again. But if you look at the market pricing for November meeting, it's 50-50, the exact same way as we went to September, right? Half of the people think it's gonna be 25, half of the people think it's 50. Now, I can tell you I think it's gonna be 25, but again, I was wrong last month. So it could be, right? We have, I think we have a couple of meetings now when the Fed can pretty much do whatever it wants because the inflation data, I mean, if you look under the hood, you see it, right? But it's not so obvious that,
Mm.
they have to acknowledge it, right? And in the labor market, you can always point to like some the job openings or hours worked or whatever. So and I could see some weakness too in the coming months because we had the election, we had a little bit of fiscal contraction in the summer. So I could see how the Fed could be able to justify another 50 bips move. The more time passes, I think the less that becomes likely. So I would bet against the cuts in starting in my view is by Q1 of 2025, these guys are done.
Mm.
That's it. With that, maybe they kept like 4 times before that, and then we start getting strong data rolling over, and but the market keeps pricing these one cut a meeting. So that's where I would focus. I mean, I would be long rates, meaning I want to benefit if rates go up, or not go up. Sorry, do not go down as much in
Mhm.
2025. That's where I see the most value.
Yeah, but
If
you've
I
gotta
had
look
to bet,
out a little bit for that, right? You thinking this is not until next year?
yeah, early. I mean, I would bet. I mean, you could place the bet now. So for
Yeah.
futures, but maybe instead of because I've just been burned with September, right? So maybe instead of like making an active bet on 25 versus 50 in November, where there's a chance that a very dovish Fed might surprise you. I think as we get into 25, the data is going to be so clearly on the inflationary growth camp that the Fed won't be able to maintain this pace of like one cut a meeting that the market's pricing.
Mm. And let's just round it out with commodities because you're in the camp that inflation is a problem and
Right.
that even if the Fed is aggressive now, they're going to have to either stop or take it back. We are going to see inflation reemerge rather. So is commodities, do you like commodities here? Is that the play given the outlook or do we have to see a little bit more on the economic front and what happens with the global economy?
Yeah, I mean the thing about commodities, and I think that's part of the confusion, is China consumes half of everything, right? So I think we see these weak commodity prices, and we mistakenly attribute them to, oh, that must mean something terrible is happening to the U.S. economy. Well, the U.S. economy stopped really mattering on the demand side about 10 years ago. It's really about China. And then where the US economy matters is on the supply side. I mean, the US is now the largest producer of energy product in the world. I mean, we are crushing Saudi Arabia. We're producing almost 14 million barrels per day. So you have this combination of strong oil output, strong output in the US, and then somewhat weak demand in China. Same thing in Europe. If you look at the spread between Brent and WTI, if you look at crack spread in Singapore, you see that indicator final demand in Europe and Asia are weak. Uh, but we're reading this wrongly as a indication that the U.S. economy is weak, and that it's about to turn around. I mean, commodities generally, I don't believe commodities is like this kind of Dr. Copper, whatever. Like they tell you much about the cycle. I mean, because commodities has to be consumed now, so commodities tell you very little about the future. Like the fall of commodity prices, to me, actually tells me that it's good. It's going to subsidize the U.S. consumer. It means that people will have more money, you have more real gain. So it actually, I view that as a positive, not a negative. That was an economist answer on which commodities to own. I'm not a specialist. I think oil has oil is an interesting one, right? We are seeing indeed a lot of people very short oil. Um, if I'm right about the U.S. economy not being as weak, not having a recession in the U.S. and China kind of bouncing around, uh, it probably makes sense for oil to rally. And then after that, you really need to talk to experts. In general, yeah, I mean the obvious one is gold and silver, and it's just been a very interesting bull market, by the way. I mean, you love bull markets when no one cares about them, right? I mean, you see gold move by $100 in 2 weeks and make new highs every day, and no one seems to care. Gold would be very a very obvious beneficiary if of that dovish pivot if confirmed, which I cannot believe it is at this point. The Fed has told
Yeah.
us, hey, I'm gonna cut rate within unemployment at 4% with inflation, core inflation at core service at 4.4. What that means for gold is obviously very bullish.
Yeah. Great stuff, Vincent, and a lot commodities are always there's always a lot of cross currents there, so we have to be careful, but, really interesting period we're in for, and we had a lot of people, Akash, that one was for you. I know you're watching gold really quickly, but fantastic stuff. Vincent, I hope you feel better. Again, appreciate you, coming on and sharing your views with us in this kind of, volatile time. It was pretty calm, by the way. We're in this like wait and see period, but you can tell people are trying to figure out where do we go from here now that we've seen such a big move. We've got the election coming. So a lot for us to mull over. So thanks so much. Just a programming note, wanted to mention that I have two really, really fascinating interviews. One of them talked a lot about oil, and I'll share it with you, Vincent. I think you'll really want to hear from it. And a really, really interesting conversation around defense. We're going to bring you both of those special episodes this week. I'm going to be running into New York a lot, doing some events around the United Nations General Assembly. Going to be talking a lot about energy there as well as a bunch of other things and geopolitics. So we'll bring some of those insights back as well. But Vincent, thank you so much. Always appreciate talking to you.
Thank you, and wonderful being part of your show. Best of luck, and
Thank
I
you.
hope to see you again when my voice is better. Thank you
Yes,
so much.
absolutely. Take good care of yourselves. And thanks to all of you for tuning in. As always, take care and good luck out there.